Choosing between a solo 401k and a SEP-IRA could literally save or cost you $50,000 in taxes over 5 years. And most self-employed people are picking the wrong one based on incomplete information. I'm breaking down exactly why, with 2025 numbers, contribution limits, and side-by-side tax savings calculations at 3 different income levels. No fluff, just the math that matters. Let's start with the headline numbers everyone gets wrong. Both plans max out at $69,500 in total contributions for 2025. But, and this is critical, how you get there is completely different, and that difference determines which plan actually saves you more money. Here's the solo 401k structure. You contribute as an employee up to $23,500 in 2025. That's your elective deferral. Then, as a business owner, you contribute as an employer up to 20% of your net self-employment income. Combined, you can max out at $69,500 total. The SEP-IRA works differently. You contribute as an employer only, up to 20% of your net self-employment income, capped at $69,500. There's no employee deferral component. Why does this matter? Let me show you with real numbers. Scenario 1. You make $75,000 in net self-employment income. With a solo 401k, employee deferral, $23,500. Employer contribution, 20% of $72,700 after self-employment tax adjustment, $14,500. Total, $38,000. Tax savings at 32% marginal rate, $12,160. With a SEP-IRA, employer contribution 20% of $72,700, $14,500, total $14,500. Tax savings at 32% marginal rate, $4,640. At 75K income, solo 401k saves you $7,520 more in taxes. That's not rounding error, that's real money. Scenario 2. You make $150,000 in net self-employment income. Solo 401k, employee deferral, $23,500. Employer contribution, $247,400. $29,480 total, $52,980. Tax savings at 37% marginal rate, $603. Employer contribution, 20% of $147,400. $29,480. Total, $29,000 at 37% marginal rate, $10,908 difference. $8,695 is more in tax savings with solo 401k, and we're not even at high income yet. Scenario 3. You make $250,000 in net self-employment income. Solo 401k, employee deferral, $23,500 capped. Employer contribution of $40,700, $49,140 capped. Total, $69,500. Tax savings at 37% marginal rate, $20,750. SEP-IRA, employer contribution 20% of $45,700, $49,140 cap, total $49,040. Tax savings at 37% marginal rate, $18,182 difference. $7,533 more in tax savings with solo 401k. So across all 3 income levels, solo 401k is winning on pure contribution capacity. But wait, there's more. Let's talk about what makes solo 401k actually different beyond contribution limits. First, solo 401k allows loans. You can borrow up to $50,000 or 50% of your vested balance, whichever is less, and pay yourself back with interest. That interest goes back into your account. SEP-IRA does not allow loans, period. Your money is locked until 59.5, or you pay the 10% penalty plus income tax. Second, solo 401k allows self-directed investing. You can invest in real estate, private loans, private equity, cryptocurrency, alternative investments. SEP-IRA restricts you to traditional brokerage investments. Third, solo 401k allows Roth deferrals. You can contribute to both traditional and Roth within the same plan. SEP-IRA is traditional only. Now let's talk about the one scenario where SEP-IRA wins. If you have employees, even one W-2 employee, you must contribute to their SEP-IRA at the same percentage you contribute for yourself. With a solo 401k, you're required to include employees, but the rules are more flexible and you have more control. SEP-IRA forces matching. If you're a one-person shop with no employees, this doesn't apply. But if you're thinking about hiring, this changes the calculation. Example, you make $200,000 and you hire one full-time employee making $60,000. With SEP-IRA, you'd contribute 20% for both of you. Your contribution, $40,000. Employee contribution, $12,000. Total cost, $52,000 to your business. With Solo 401k, you can get creative. Solo 401k safe harbor rules and Solo 401 non-safe harbor rules give you options SEP-IRA doesn't offer. But here's the reality. Most self-employed people don't have employees. If that's you, Solo 401k is almost always better. Let's talk deadlines because they matter for 2025 planning. SEP-IRA. You can open and fund a SEP-IRA for 2024 until April 15, 2025, or October 15 with extension. This gives you maximum flexibility. Solo 401k. You must open the plan by December 31, 2024 to make 2024 contributions. But for 2025 contributions, you have until the tax filing deadline, April 15, 2026, or October 15 with extension. This matters if you're reading this in January 2025. You've already missed the window for 2024 Solo 401k contributions. You can still open a SEP-IRA and fund it for 2024. This is actually an advantage for SEP-IRA if you're behind. Admin complexity. This is where people get frustrated. You fill out IRS Form 5305-SEP, give it to your bank or brokerage, and you're done. Super simple. One document, no annual filing. Solo 401k. You need a plan document, custodian setup, and some providers require Form 5500 annual filing if your balance exceeds $250,000. More administrative burden, but it's not nightmare-level complicated. Most Solo 401k providers handle this for $50 to $300 per year. If admin simplicity is your priority, SEP-IRA wins. But the tax savings from Solo 401k usually exceed the admin costs by thousands of dollars. Here's the strategic play most accountants won't tell you. If you're self-employed with inconsistent income, you might use a SEP-IRA for years where income drops and a Solo 401k for years where it spikes. Contributions are based on current year income, so a SEP-IRA lets you adjust more easily year to year. But honestly, once you pick Solo 401k, you're usually better off staying there. The flexibility and tax benefits compound. One more thing nobody talks about. Solo 401k plus backdoor Roth strategy. You can make non-deductible Solo 401k contributions and then convert them to Roth. This creates a legal backdoor Roth strategy at higher income levels where you're supposedly phased out. SEP-IRA doesn't have this flexibility. It's all or nothing, deductible contributions only. So here's the decision framework. Choose Solo 401k. If you're self-employed with no employees or only spouse, you want maximum tax deductions, you might need to borrow from your retirement plan, you want investment flexibility, self-directed assets, you want Roth conversion options, you're willing to handle minimal admin, it's really not bad. Choose SEP-IRA if you want maximum simplicity and fastest setup, you have W-2 employees and want to avoid Solo 401k complexity, you're behind on 2024 planning, you want zero annual compliance, your income fluctuates significantly year to year. Bottom line, for most self-employed people, Solo 401k saves between $5,000 to $25,000 in taxes over 5 years compared to SEP-IRA. That's money you can reinvest in your business or keep in your pocket. The admin burden is minimal. Most providers cost less than $200 a year. The tax savings dwarf that cost immediately. But the real win is the flexibility. Loans, Roth conversions, self-directed investments, and control. That's worth something too. If you're self-employed and you're not maximizing one of these plans, you're leaving money on the table. Literally. We've got a full retirement plan setup guide linked in the description if you want